name is Dan Massey. I want to welcome you to our webinar today. We appreciate all of you taking the time to log on and listen to what we have to say about the loan forgiveness application that came out on Friday. Presenting with us today will be myself, as well as Ben Ritenour, a manager in the firm, and between the two of us, we try to administer the firm's response to all things Paycheck Protection Program related. So we've got a number of people on our team, but we'll be the ones presenting with you today. Just a couple things so that you know how to proceed today. There is a question and answer option on through Zoom. So if you've got any questions, feel free to send those to us. We will attempt to get through those at the end of the session. Those that we cannot get to during this hour, we will respond to you via email. Also, if you've got a team member or someone else on your group that is not able to join us here, we are going to make sure that this, we're recording this, it will be sent out to you via email. It will also be on our YouTube channel a little later. So just wanted to let you know about that. As many of you know, I mean, if you're listening to this, you are certainly familiar with the CARES Act and the Paycheck Protection Program. And if you're listening to this, you probably got a PPP loan, so congratulations for that. And now you want to know more about what it's going to look like to have forgiveness. So back on what seems like an eternity ago, March 27th, the CARES Act was signed into law. And since then, you know, we were expecting some additional guidance. After that point, we did get some through various FAQs that the Treasury has put out, as well as some interim final guidance rulings. Most of those came out through May 14th. There was a couple that have come out since then, but most of those have, the last couple have not been entirely consequential to a wide base of businesses. Then, of course, the application for forgiveness and the related instructions for that application were released Friday afternoon, evening by the Treasury, so May 15th. So we're about 5 days since then. We've tried to get through it to the best of our ability and answer your questions. As we'll talk about here, we've got through, there's a lot of clarifications that were issued. There's some still unclear issues remaining. So we'll try to identify what those are as well. So just an outline for today, so you know what to expect. We're going to talk about what has come out since our April 14th webinar. We're going to talk about just some things you have to be aware of before you get into the whole application, forgiveness application process. We're going to spend a good deal of time on what we've learned, which is important, and there is a lot. We're also going to talk about the few things that we haven't learned yet, which is also important. We'll finish up by talking about how we can help you. And then as time permits, we'll go through a few questions and answers. But like I said, if we don't have a chance to respond to your chat in this hour, we will certainly get back to you via email. So information that has come about since April 14th, which is the time of our last widespread webinar when we were just taking an initial look at forgiveness. There's been a number of things that have come out, but there's two major things that we think everyone ought to be aware of, and you probably already heard at some point. One of them is the taxability of any forgiveness on this loan. The law, the CARES Act, specifically says that the forgiveness income is not taxable. The IRS took that and kind of worked around it and said, okay, well, that's fine. We won't tax the income, but the expenses that are related to that, we are not going to deduct, or they're not going to be deductible, which in essence is the same thing as making any forgiveness taxable. So not something that appears to be the intent of the law, but this is the IRS ruling. There are some lawmakers pushing back from what we understand, although that could take, quite a bit of time. So we think that anyone listening to this and anyone that we're advising ought to be prepared to have their forgiveness portion be taxed, at least at the federal level. One other thing while we're talking about lawmakers and and their reaction to this. We've gotten a lot of questions over the last couple of days about, and you're going to, obviously you know about the 8-week period. We're going to talk a lot about the 8-week period for spending to be forgiven during this webinar. There, Secretary Mnuchin just yesterday was on TV, and he said that he was hoping to extend that 8-week period. That's not part of the law. If the 8-week period is extended, it's probably going to have to be an act of Congress. He indicated there is, bipartisan support for that, but we are not assuming that that's going to happen. We know that some of you are probably in the 7th week of your 8-week period, especially if you were one of the first ones to get funded. So while that, scuttlebutt is out there, there's nothing official yet on that. We think that you should plan on there just being 8 weeks and there not being an extension. The other thing that came out that's really important since April 14th was, how these PPP loans are going to be scrutinized. There's a good faith certification that everyone had to sign when they applied that basically said economic uncertainty made this loan request necessary. When public companies and large companies like the Los Angeles Lakers applied for loans and got them, there was certainly a public outcry about that. So the subsequent guidance said anything over, anyone under $2 million of loan will be deemed to have automatically made that certification in good faith because they don't have, based on their sheer size, they don't have additional liquidity. So anyone with a loan under $2 million automatically meets that good faith certification. Anyone over $2 million is going to be audited by the SBA or the Treasury in some capacity. What that looks like, we don't know, but documentation will be very important for all loans, but especially those over $2 million. In fact, there's even a check the box spot on the application that says either you or together with affiliates, that would be like a sister company or something like that, did you receive loans in excess of $2 million? So they definitely want to be, they're definitely going to scrutinize those loans. So just be prepared for that if you've got a significant loan. So at this point, I'm going to turn it over to Ben and let him talk about the just some general caveats as well as what we've learned, and then I will join you back at the end. So go for it, Ben.
Thank you, Dan. I appreciate the introduction. Appreciate providing an outline and getting the ball rolling here. Welcome, everybody. Appreciate your interest in the topic. I appreciate the time that you are giving to learn more about it. My guess would be many of you have already taken some time reading through the connection and trying to do the best you can to steward the amounts you received and to maximize your forgiveness where you can. We are going to dive into some details today. Our intent is to cover as much as we can, to cover as many of the bunny trails that we can, but a lot of the bunny trails are going to be unearthed as you, the businesses, dive into this and say, well, in my business, here's a fact pattern I have, and this is what I'm seeing. Is this what should be happening? And how should we do that? So all that to say, as you listen and you have specific questions that relate to your business, or as you listen and say, hey, I read this in the application or in the instructions and I thought you would cover it today and you didn't, please ask questions. If we don't respond to them today, we will try to respond to them as soon as possible. Dan and my contact information will be available at the end of the slide deck. And we encourage you to ask those questions. So as we dive into it, we want to give the caveat that the beginning application included instructions that weren't necessarily followed by all the banks. The one that specifically comes to mind is using the calendar year 2019 as the baseline for your payroll spend on the application. And that's just an example, but what it does do is makes it so that there is a reality that as much as we would like to think that the form and the instructions to the form are the Bible as it relates to PPP loan forgiveness, we need to keep the context in mind that typically from an authoritative perspective, the form and the instructions aren't necessarily the highest form of of interpretation, that they aren't necessarily law. So that aligns with the next point, to where we do not know yet what additional FAQs or guidance may be coming out over the upcoming days and weeks, whether they would reinforce interpretations we have or contradict interpretations we have, or even potentially contradict the information in the application and instructions. So we have an application, we have instructions. To date, they are the most informative item we have received on forgiveness, but we just want to have the caveat and keep it in mind that, you know, as we had to react to some things in the application process, there may be some reacting that needs to be done through this forgiveness process as well. So if you've dived into the application, and as I've read through it and as we've read through it, there's four main parts to it. What I find is intriguing is that the instructions come before the actual application, which I think somewhat, I don't know if it was intentional, but in my mind, it somewhat emphasizes the fact that the instructions are important. The line by line, what are you supposed to do here? What are you supposed to do is important. And if you look at the application and you start reading it, on the first page, you're going to start seeing some things that it's like, wow, I haven't seen that before. So we're going to dive into that. But as it relates to the application, there's four parts. There's the PPP loan forgiveness calculation form. That is a simple one-page form. There is a signature page, that's the second page, with some representations and certifications. But the actual application, the actual calculation form, it is one page long. It is not lengthy. It is not extensive. There is a lot of work that will come into filling in the information, but practically it's an 11-line calculation. And if you think about it, even the first half of the top part of that page is primarily informational that doesn't even impact the bottom half calculation. So a few things to note just from the top. If you're having somebody help you with this, if the Walz group is helping you with your loan forgiveness application, there's information specific to the loan that will be needed. So you're going to need your loan documentation, your loan documents. And the other thing just to address, because I assume the question will come up, is at the top, similar to on the actual loan application, it asks for employees at time of loan application and employees at time of forgiveness application. And we're going to spend a lot of time talking today about full-time equivalents, but I wanted to differentiate that the employees that it is asking you to report here on the beginning at the time of the loan application and at the time of the forgiveness application, that's not necessarily full-time equivalents, that's just total employees. How many full-time and part-time employees did you have at that time? So that's one thing I wanted to mention towards the top. Like I said, the second half of the first page is the actual calculation. And then page 2 of that kind of follows right behind it is the representations and certifications. I'm not going to go down through those line by line. What I would recommend you do is take some time to read those. Essentially, you know, the summary is pretty simple. It's saying that you're asking for forgiveness for what you're supposed to ask for forgiveness for. Everything is accurate, and you've submitted documentation to prove it. But I do recommend you read through those. And in a lot of these areas, and we're going to talk about this a little later, there's going to be some potential gray areas. At some point in time, we're going to have to file an application, and there's probably going to need to be decisions made and gray areas gone into that we're just not sure of the answer. And we want to go into those gray areas ethically, and you want to hopefully go into those gray areas ethically. But as you determine, hey, how far can I go? Where am I comfortable going? I think it's good to read the representations and certifications. As we go on from there, there is the PPP Schedule A. And the Schedule A, if we want to go back to the previous slide still, the Schedule A for the most part supports a lot of the numbers on page 1 of the actual application. And Schedule A has a few calculations embedded in it, but largely it is just an accumulation of information that then flows to the application. And practically speaking, as we go into this, The calculations aren't incredibly convoluted or difficult, but there is going to need to be work that needs to be done to gather the information that goes into the calculations. There's a lot of different segmented information that's need to be gathered, and it's going to need to take some time. The nice thing is that it feels like with what we have learned through this process, that we're actually going to be able to start gathering that information. Whereas before there were some questions in terms of, hey, what exactly are we supposed to do for this? A lot of those questions have been answered. So in a lot of ways, some of the work can start to begin. So that is the PPP Schedule A. Then there's the PPP Schedule A worksheet, which that supports a lot of the numbers in the PPP Schedule A. So whereas the PPP loan forgiveness calculation form is required, the PPP Schedule A is required, the worksheet is not required. However, from our perspective, it would be recommended. Practically speaking, I don't know if you have to come up with something in the exact same form as the worksheet. We have tried to create a spreadsheet that somewhat mirrors the worksheet, and it is a very, very large and complicated endeavor to do so, to where internally, at least in the calculation that we've come up with, we've broken it into different parts. So I don't know if you actually need to come up with something that looks exactly like the Schedule A worksheet, but the information that the Schedule A worksheet is accumulating, you're in large part going to have to do. So even though it's not required, the content that goes into it and the work that goes into it, you're going to need to do in order to complete Schedule A and the calculation form. And then the last part of the application is there's an optional PPP borrower demographic informational form. This has really no impact on the rest of the application. It appears to be mostly an information gathering endeavor, and it's looking for demographic information of the business owners. It's not, you don't need to complete it for every employee. It would just be for the owners, but that should have no impact on your forgiveness application. It should just be information. So some of the things that we learned as we look into it, on the very first page of the instructions, on the page 1, if you Google it, if you haven't looked at it yet, if you go on Google and you Google SBA loan forgiveness application, you're going to see pretty quickly and find one. And if you are to open that up, you're going to see one of the things on the first page. It references the alternative payroll covered period. If we want to go to the next slide, what they've done for us here, and this is only for borrowers with a bi-weekly or more frequent payroll. So if you are a semi-monthly, monthly payer, or quarterly payer, you cannot take advantage of this option. By and large, it shouldn't negatively impact you. It could make things slightly more complicated, but they've put in a couple other things that kind of smooths even the regular covered period over. So the alternative payroll covered period, it is still an 8-week period, but as contrasted with the standard covered period. So the standard covered period would have started on the day that you received your loan proceeds. The alternative payroll covered period allows you to elect to start that 8-week period just for purposes of payroll costs on the first day of the first pay period that followed your PPP loan disbursement date. So we're going to look at a calendar here in a minute or so that will kind of visually depict that. But if you think about if you think about having a partial period at the front of your 8-week period, and then 6, in theory, regular weeks in the middle, and then a partial period at the end, this has essentially eliminated that, and you're going to have a nice, clean 8-week period that is your payroll covered period. And that should align if you're a weekly or a bi-weekly or more frequent than that payer. It will align with your pay period. So that is nice. Now, as we talk about non-payroll costs, those non-payroll costs being interest, your mortgage interest, your rent, and your utilities, the alternative payroll covered period does not apply to those. That is still going to be your standard 8-week covered period, start on the date of your loan disbursement. But there was a little bit of good information along this. So let's read this gray area here. And eligible non-payroll costs must be paid during the covered period or incurred during the covered period. So in the law, that is an and in the instructions, it became an or. So either paid during the covered period or incurred during the covered period. and paid on or before the next regular billing date, even if the billing date is after the covered period. So what it appears this does is, let's say you had a March bill that, for a utility that didn't come in until April and you paid it in April. So that wasn't incurred during your covered period. But let's say you got your loan proceeds at the beginning of April. It wasn't incurred before you got your loan proceeds, but you paid it after you got your loan proceeds. It appears as this is pulling that in. You have now paid for that during the covered period. And so then conversely, your April that you pay in May, you're gonna get. And your May, this allows you to pick it up after the covered period, even if that billing date is after the covered period, as long as you pay it with the next regular billing date. So we think in a lot of instances, this is going to allow for 3 pays to be picked up. That's going to depend on the timing. Obviously, you didn't have this ahead of time to plan for, but it could give you a little bit of wiggle room. Now, as it relates to paying stuff before the next billing date, the instructions specifically say you may not prepay the mortgage interest. It doesn't use the prepay language as it relates to utilities and rent, but practically speaking, you're not going to be able to prepay your utility. You're going to pay that in accordance with the bill. And the rent, I think that they feel like they're probably protected there, because you're going to have to pay the rent in accordance with the rental agreement, which was signed before February 15th. So the thought process of, hey, maybe I can pay a couple extra months of rent and get that in there. I think their thought process is probably that they're covering that by saying that you have to pay it in accordance with the rental agreement that was in place. But all that to say, think about your non-payroll costs, because it looks like we may be able to get 3 pays in this 8-week period. And they even opened up the back end a little bit for some administrative simplicity to allow you to pay things after the covered period, as long as it's paid within the paid before the next regular billing date. So let's look at the alternative payroll covered period and the covered period kind of on a calendar basis. So what you have here, if you look at the top 3 months, that is under the covered period. And if you look at the bottom 3 months, that's under the alternative payroll covered period. And again, as we discuss this relates to your cash compensation, your gross compensation. It relates to your health insurance. It relates to your retirement. It relates to your state and local taxes assessed on income paid by the employer. So both of these, this isn't it used to be the covered period, and now it's the alternative payroll covered period. These are your options. You can choose these. So in the covered period, you had, let's say in this example, we're saying you got your loan proceeds on April 7th. So your 8-week period goes from April 7th through June 1. So if you look at the beginning, you had a pay period that ended on the 4th and got paid on the 10th. So that was not incurred during your period, so that during your covered period. So that payment on the 10th was not a forgivable payment, even though it was paid within the covered period. So then you had your days, your pay period from the 5th through the 18th, of which you would pick up 12 of those days from the 7th through the 18th. And then you would have 3 regular pay periods. And then you had your pay period, ending on the 30th, and you have the 31st and the 1st, which kind of prior to this, we were saying, hey, you're going to probably have to run a special payroll if you want to get those. And you're probably going to have to run a special payroll for the pay period from the 17th through the 29th, because that's not going to get paid until the 5th. So there was some planning needing to be done to potentially do a special payroll, and it's on the next slide, but I'll let the cat out of the bag a little early. But what they've done is they have said that you can, I'll read it exactly. Payroll costs are considered incurred on the day that the employee's pay is earned. Payroll costs incurred but not paid during the borrower's last pay period of covered period are eligible for forgiveness if paid on or before the next regular pay date. So similar to the non-payroll costs, for payroll costs, you can pay this pay period ending on the 30th as long as it is paid before the 5th, that still counts as being paid, even in the covered period. That's not an alternative payroll covered period concept. That is a concept that applies to the covered period as well. So as long as you pay the 30th by your regularly scheduled pay date of the 5th, you are in the clear. Now, it is interesting to think about. So that covers your pay dates through the 30th, but what about the 31st and the 1st? Well, the instructions say that you are eligible to pick them up if they are paid on or before the next regular payroll date, which in this instance, the next regular payroll date is the 5th. So I believe the intent of the instructions is for you to be able to pick up the 31st and the 1st. I think they want you to be able to get 8 weeks, but practically speaking, in this instance, it would appear as though there may be some struggle aligning the 31st up with the 1st, the 31st and the 1st, and saying that that is going to be paid by the next regular payroll date, which is the 5th, because the 31st and the 1st wouldn't typically be paid until the 19th. So there may be some instances where we still need to talk about a special pay. I read that, and I read that 6 times and thought, okay, that's fine. You can just pay it on the 19th. And then the 7th time I read it and said, boy, if I take that literally, they're saying that needs to be paid by the 5th. So if you find yourself in that circumstances and you're in the covered period, let's talk about it. Let's think about it, and maybe something to talk with your bank about, and seeing how they're going to interpret it, but wanted to bring that to light. Now let's talk about the alternative payroll covered period. So in the alternative payroll covered period, you can start your covered period for payroll costs starting on the first date of the first date of the first date of the first pay period after you receive your loans. So that is April 19 in this instance. So your pay period ended the 18th. Well, so your pay period that started on the 5th, that was before the loan proceeds. So you don't pick that up. You start on the 19th, and you have a clear cut April 19 through June 20 4 payrolls for a biweekly payer. You pay it on the 19th, and you get to pick up those full 8 weeks. So that is a lot cleaner, should be less administrative burden. So let's think about this practically. And in my mind, as I think about it, if we're trying to maximize our costs, let's say you have an instance where you got your proceeds on the 7th and you said, okay, I need to start hiring my people back. And you brought more people back on payroll, but you didn't snap your finger and they all showed up on the 7th. It took a few days to get those back. In that instance, the alternative payroll covered period, you're probably going to be able to get additional payroll costs because you're going to have more people on payroll during this time if you use the payroll, if you use the PPP proceeds to hire people back. And additionally, you're probably going to have higher FTEs for purposes of that calc during this time as well, because you have more people on payroll. Conversely, if you kept people on payroll at the beginning, and as things have progressed, even though you had the PPP loan, you have reduced staff, you may be more incentivized to use the covered period because you had more people on payroll at the beginning of this time. You had more people on payroll at the beginning of April than you did in the middle of June. So that's going to be facts and circumstances. Those both options are out there, and I want to emphasize that this, by electing either the covered period or the alternative payroll covered period, you have to apply those dates also to your health insurance costs, your retirement costs, and your employer paid state and local taxes assessed on income. That applies to this payroll. Okay, next slide. And the next slide I pretty much have already covered. That is talking about the payroll costs incurred but not paid and being eligible, so we can skip past that pretty quick. Okay, another thing we learned, if you go back to our April 14th, I had a little fun, we had a little fun thinking about the fact, okay, what is a prorated $100,000? Because practically speaking, if you think about it, 850 seconds is 15,385, but 850 seconds is really 56 out of 264. In a typical year, there's 365 days, and in the leap year, there's 366 days. So your mind can start to wander a little bit about what that number was, but they cleaned that up and said, okay, the prorated amount is 15,385. That's an important number. So one thing that did come out, and this our interpretation is that it's one of the unfavorable things that came out, and I think it's going to throw some wrench and some tire wheels, is that owner compensation is still limited, forgivable owner compensation is still limited to the prorated 100,000, which is 15,385. But they put in the application and the instructions that it is 15,385 or 8/52 of their 2019 compensation, whichever is less. So let's say you had an owner that was making $70,000 a year last year in 2019, and you got these PPP loan funds and said, hey, we can give our owner a raise. Let's bump them up to $100,000 and put some more money in their pocket. They have kind of put a roadblock on that theory and that idea, and they have limited it to the lesser of 15,385 or 8/52 of 2019 comp. Now, if 2019 comp was over $100,000, it doesn't make a difference. It's only in that scenario where pay has been increased during this time to try to take advantage of the loans. A question in this area, and it is open to interpretation. I will give you our interpretation at this stage. But we believe that we are right. We believe it is in alignment with everything that we have, but just wanted to acknowledge it as a question, which is what is included in owner compensation, and owners being owner employees, self-employed individuals, or general partners. They don't define it any more than that, but those are the terms that they use as an owner. But if you actually look at the form, there's a line for cash compensation for non-owners. There's lines for health insurance, there's lines for employee retirement, and there's a line for state and local taxes paid by the employer for employees. And then there's a line for total amount paid to owner employees, self-employed individual, general partners. We believe that that line is just intended to encompass compensation. Cash compensation is not intended to apply insurance, retirement plans, and state and local taxes. But if you're picking up guaranteed payments or some form of payment to an owner that may have those other ones, in those instances, you could have some of those additional payroll costs over and above the typical, what you would typically view as cash compensation, be limited to that 385. We don't think for other owners where they get a W-2 that it's included in there. But I will acknowledge that's our interpretation. It's not explicitly clear on that topic. So if you have questions about your specific instances there, let us know and we can talk through it. Let's talk a little bit now about the FTE calc. This was an area where the original law seemed to indicate, it was our understanding that the original law said that an ACA methodology was what was supposed to be used. Which the ACA methodology is on a monthly basis based off of 30 hours. There was some questions because you had one place where it said use ACA, which is more of a monthly basis, but then within the law it talks about on a weekly basis. So we get the instructions now, and it says that your FTE is the average number of hours worked per week divided by 40. So I did not see anything from anybody prior to this saying that they thought it was going to be based off of 40 hours, but that's what it turned out to be. So if you have already done work based off of 30 hours, I apologize. We for sure have done work internally as a firm based off of 30 hours. And that is not what came out. So it's nice that we have an answer. We know what we're supposed to do, but it is a 90-degree turn from where we thought we were going to be before. So there's kind of your standard where you take the total, average hours paid per week during a certain period and divide that by 40, or they also have what's called the simple method, or is a simplified method, where if you have someone that's 40 hours or more, they're a 1, and that's consistent with the first one. But then everybody else who works less than 40, you can just put them as 0.5 and move forward. I believe for most people, it will be advantageous to run the numbers and see what's most beneficial. There's just due to how it's a fraction and how you have to apply this concept consistently to all the different periods you're measuring. I think the only way to figure out which one is best is to do the calculation and calculate both ways and see which one is best. I don't think it would be advisable to take a guess at what you think would be best and just do one of them and move forward. I think it would be good to do both. The other thing to mention is for purposes of FTE calcs, owners are not FTE, so they are not supposed to be included as an FTE. And this is something that we feel is somewhat detrimental as well, especially if you're a smaller business where, let's say you have, 7 people on payroll and maybe 4 of them are owners. And, if you had some reductions in staff and you were taking a number divided by 7, well, that's one thing. But if you have a number now that's divided by 4, that could be giving you a significantly different number. So that is something that, again, came out of left field. Nothing really had been said about that before, but that's what's here, that owners are not included in the FTE calc. And owners are the same thing as with the compensation, where it's employee owners, it's general partners, it's self-employed individuals. Now, practically speaking, if you think of a self-employed individual, if you're a single person crew on a Schedule C, at least when I went to school, 0 out of 0 gave you an error. We're assuming that that's still 100% from an FTE if you've worked this whole time, but that's just an interesting little tidbit. Another thing along the FTE that they did here, if you get our emails or you've been following this, you know that a week or so ago, time flies, maybe it was more than a week or so ago, but in the not too distant past, they came out with some information that said, hey, if you offer to hire somebody back and they say, no, thank you, I would prefer not to come back. If you get documentation from them showing that you offer them and documentation saying that they are refusing to come back, they don't want to come back, that won't hurt your FTE. So that is still included in the application. But what they also did is they said that you won't be negatively impacted for terminations, resignations, and requests or requested hour reductions during the covered period. So what that does is, let's say you had somebody that you terminated for cause during the covered period, you don't get negatively impacted for them. If your FTEs went down because of those, then you don't get negatively impacted. Now, they don't really say how you're supposed to do that. Practically speaking, a logical perspective would say, hey, if they were a 1.0 FTE before, and as a result of them being terminated or them resigning, they were now a 0.5, that you could make the 0.5 a 1, or maybe you add up the total covered period, and let's say you were at 50 and now you're at 49.5. You add up your 49.5 and you get to add 0.5 to the bottom and you get to 50. My assessment is that's what they're trying to do, but it really doesn't say how to do that. I think as a firm, that's what we're going to request. We're going to request information saying, hey, have you had any rehire refusals? Have you had terminations? Have you had terminations for cause? Have you had voluntary resignations or requested hour reductions? And, we're going to kind of gross those up. I think that's going to be a gray area that if we don't get any more information, we're just going to have to make a decision. Next slide. So just to look at the FTE calc real quick. So the instructions say to do the average per week. So if you look at employee A, I kind of just put in some random numbers here, to be honest, but it adds to 304, which for the 8-week period works out to 38 hours a week. And your FTE calc, because you round to the nearest 10th, you've got a 1.0 FTE, but for the simple FTE, because they're less than 40, you're at 0.5. So 2 things I want to point out. One, if you look at the actual and simple, you can see in this instance, the actual gets to a bigger number. But also I want to point out, they say to do the average per week. Practically speaking, if you just did 1 week and put in 304, you'd get to the exact same number. So based on experience with the application, we think some banks may want to see the detail. So we're recommending you fill in the detail, but practically speaking for the calculation, it's just 304 divided by 8. And then that 38 divided by, and then that gets you to 38, which is divided by 40. So if you're working through these and you say, why are you making me do all this work? It's because we think some banks may want it, but practically speaking, it doesn't change the numbers. Also for salary, it doesn't really say how many hours you're supposed to use for salary. So we're kind of taking the approach to say it's how many hours did you expect them to work with a max of 40. But if you have maybe a 35-hour hourly person, then put in 35. That's what was expected of them. Next slide. I think I need to go a little quicker here. FTE reduction safe harbor. One of the biggest things we have been waiting and hoping to get answers on is how do you prove that you have eliminated any employee reductions by June 30? And the answer is that the application and the instructions did absolutely nothing to answer that question. It is silent on the topic. And my opinion, which isn't worth too much on the subject, is that that was intentional. If they wanted to give us that information, they would have given us that information. They gave us information on pretty much everything else. They have to know that this is a huge deal. And it's just not there. So if you can read the second bullet point there that is fairly lengthy, but practically speaking, it says the same thing that the law says. The one thing that they did add is they also added another kind of, they don't even call it a safe harbor. It's not even in the instructions, but it's on the form. And it says, if you have not reduced the number of employees or the average paid hours of your employees between January 1 and the end of your covered period, check this box, and your FTE reduction quotient is 1. So how you prove what your FTEs were at January 1 and the end of your covered period, it doesn't say that. Practically speaking, I think for most businesses, by doing the FTE calc, you'd be in the ballpark of 1 anyways if you did that. But there is a line now on the application that says if you had no reduction between January 1 and the end of your covered period, check this box, and it's 100%. So that is brand new. There was nothing in the law about that, but it is there now. There is not even there's nothing in the instructions to expound on that, but it is there, and for your consideration and something that we can talk about if you think that is impactful for you. And the other point I want to make is that it appears as though the FTE safe harbor, whereas originally we thought that you had to have eliminated any salary and wage reductions as well, it appears that that is independent of salary and wage reductions. That if you have salary and wage reductions, you get penalized for those, but those don't impact your ability to claim the FTE reduction safe harbor. So that's a good thing. Next slide. Salary and wage reductions. This was pleasant. As a firm, we have talked internally about, you know, what we'll call it the double whack, where let's say you had somebody and you reduced their hours, so you paid them less during your covered period than what you did in the first quarter. So in that scenario, you were going to get an FTE reduction because they were a lesser FTE. And let's say if you reduce them by more than 25%, you were potentially going to get negatively impacted on the salary and hourly wage reduction because they had a reduction in pay. The nice thing from an hourly wage perspective is it appears as that essentially has gone away, and they are basing it just based off of what was their hourly wage. And if you reduce their hourly wage, then you multiply that by hours and you can calculate what your wage reduction, quote unquote, penalty is. But if you paid them less just because they worked less hours, you don't get penalized for that. So that is good. I don't think you quite get the same benefit if it is a salaried person. So if you had, say, you know, a full-time $75,000 salary person, and you say, hey, can you work less, and you reduce their hours by, we'll say 30%, and you reduce their compensation by 30%. The way the salary reduction calculation works, you would still get penalized for that reduction from a salary perspective and from an FTE if you say, okay, what were our hourly expectations? And that dropped as well. So your FTE drops, and it appears as though you get whacked on the salary as well. So it appears as though there is still a double whack mechanism if you reduced a salaried person's hours and their salary, but it appears as though the hourly wage, you get freed from that potential impact. So with that said, this salary and hourly wage reduction does not need to be considered if for any employee they receive compensation from the borrower at an annualized rate of more than $1,000 for any pay period in 2019. Which that's one of those things that you can kind of glaze over. But if you think about it, let's say you're a weekly payer. So you have 52 pays in a year, $100,000 divided by 52, I think is 19 some hundred dollars. Yeah, 1923. So if you paid anybody in a weekly pay more than $1,923 for any single pay in 2019, you don't have to consider them for the salary and hourly wage reduction. So let's say you have an employee and you give them maybe it's a $50,000 employee, but you give them a $100,000 bonus one pay. You could get over this annualized rate of more than $1,000. It doesn't say, there's nothing in the language that makes it seem like you can't include bonuses and getting you to that annualized rate of $100,000 for any pay. So that 1923, if you go bi-weekly, it becomes 38 some hundred. You can do the math there, but if you take $100,000 and divide it by your number of pays in 2019, that's kind of your baseline. If you can find any employee that you paid more than that amount during any pay period, you don't have to consider them for salary and hourly wage reduction purposes. So I think that's a nice option. I don't know if that's what they intended. It seems like they would have thought that through enough, but that seems to potentially be very valuable. And you do this on an employee by employee basis. So you could have 100 employees and 99 of them don't have any salary and hourly wage reduction, but one of them does. You just get penalized for that one employee. So it's not like that gets applied across multiple areas. Next slide. So the salary and hourly wage safe harbor. This is a multi-step calculation in there, but really it's pretty simple. Was the average annual salary or hourly wage during the covered period or alternative payroll covered period for a given employee at least 75% of their average annual salary or wage between January 1 and March 31. So if their average salary or hourly wage during the covered period was at least 75% of first quarter, safe harbor met, you don't have any penalty, you don't need to go any further. If you say, oh, you know what, it was less than 75%, there's a next step that you could potentially get there. If their annual salary or hourly wage as of February 15th was reduced between February 15 and April 26th, and then they got back up to at least the February 15 level by June 30, in that instance, you've met the safe harbor and no reduction is needed as well. So those are the two potential ways that where you'll have no salary or hourly wage reductions. There's two ways to potentially do it. So if you're thinking about this and saying, oh, I guess I just need to get everybody up to their full salary and their full hourly wage by June 30 if you had some reductions, that appears to be correct. So you have two options. However, if both of those get failed, if you had more than 75% reduction in the first bullet point and you didn't reduce wages between February 15 and April 26, or if you did, you didn't get them back to the same level by June 30, at that stage, you're going to have a penalty or a reduction in your forgiveness as a result of those reductions. Next slide. Okay, 75%, 75% and 25% rule. So what came out in the calculation is different than how we interpreted the law. I think it's different than how a lot of people interpreted the law. It's different than how we have interpreted guidance that has come out since the law was passed. And it relates to the 75% rule relating to payroll and non-payroll costs. And it is, my guess is that the vast majority of time it isn't going to make a difference. There's only one small instance where it could potentially make a difference. And in that instance is if you were limited in your non-payroll costs. So you had payroll costs that were in excess of 25%. So they are getting reduced to keep it at 25%. And you had a reduction factor. You had an FTE reduction factor. In that instance, in the new calculation in the application, if you look at this, and due to time, I'm not going to go too much into the mathematical calculations, but essentially under the old method, you would have gotten to 66,000 of forgivable costs, multiplied that by 0.8, and you would have gotten to 53,333, and that would have been your forgiveness amount. Under the new method, the non-payroll gets limited through essentially a calculation. If you look under the new, you see the 66,667. That's essentially 50,000 divided by 0.75. Essentially, they say you get the lesser of that or the forgivable cost times the reduction factor. So because of just how they had the calculation set up and taking the forgivable cost times the reduction factor, you don't have that isn't impacted by the 25% limit. So in this specific instance, the new calculation results in $6,000 of additional forgiveness amount, which is essentially 8333 times 0.8. So that's a nice benefit just in terms of how they rolled out, how they interpreted their own rule being different than how we were interpreting it and how many others were interpreting it as well. And then what I wanted to touch base on here, one of the things that they asked for in the application is information about EIDL advance amounts. If you received an EIDL advance, there is no place on the form that you reduce your forgiveness by that amount. Essentially, you get to a line 11 that's total forgiveness amount, and there's no EIDL advance impact there. But on that line, it says that the SBA will reduce, in the instructions of that line, the SBA will deduct EIDL advance amounts from the forgiveness amount remitted to the lender. So how that will happen, I'm not sure, but if you received an EIDL advance, as much as they said that that doesn't need to be paid back, it does reduce your forgiveness amount. So that's just an awareness. So with that, I'm going to pass the ball back to Dan to cover a couple things that we didn't learn.
Okay, thanks, Ben. So, thankfully, there were a lot of answers as Ben went through in the last 30, 35 minutes there. So I think we do have a lot of answers. There were certainly some things that we had questions about previously that we still have questions about. Like, for instance, can I exclude X under the definition of Y? Like a common one there is what constitutes transportation under utilities? That's still a valid question that we don't have a whole lot of clarity on. So another thing we don't know is what additional guidance will be provided in the near future. We know that some people are very close to the end of their 8 weeks, which means they're going to be close to actually filling out this application for forgiveness. My sense is there's not going to be a ton more additional guidance, that they spent a good amount of time trying to come up with this application to have it be as all-encompassing as possible. Clearly, they didn't quite get to that point because there's still a handful of questions, but I suspect that we ought not hold our breath for additional guidance. Hopefully it comes, but we will see. Another thing that's important is the communication with your lender. As Ben mentioned at the beginning of his words, different banks interpret things differently, just like every business owner interprets things differently. So if your bank is going to be the one reviewing your application and sending it on to the SBA, it's going to be important to understand how they are interpreting language. And they may not have, a definitive answer, but there may be, it'll be good to at least have a conversation with them so you know what to do so that your application isn't held up unduly. Ben mentioned a little bit about how there's still some questions on the FTE reductions. So if you eliminated all of your FTE reductions by June 30th, does that need to be substantiated? If it does, how is that to be substantiated? And that comes into play for people who, if their 8-week period ends well before June 30th and they get their application done, how does that work? I know some banks have only given borrowers 10 days from the end of their 8-week period to have their application in. So then you might not even get to June 30th. So that's a question that needs to be answered. Calculation of salaried FTEs. If you're a salaried person that works 20 hours, is that a full-time equivalent? Because you might have generally speaking, you're only expected to work 20 hours, but you're on salary. So sometimes you might work 25, or sometimes you might work 30. You might not even track your hours because you're salaried. So that's the question. The aggressive standpoint would be to treat all salaried people as one full-time equivalent each, but I don't know if that's exactly what they want. In our spreadsheet, we're saying, put down the amount of hours that are typically expected of someone who's salaried. In many cases that might be 40, but it could also be less than that. We talked in our last webinar about allowable uses being from February 15th to June 30th. That was completely silent. In here, there is some dissenting opinions about what time frame you have to use those funds. Completely silent in here, so that's something that we may or may not learn more about. And then along those lines, what happens if you've got an 8-week period that goes past June 30th? Everything we're seeing says you can use all of those costs during the 8 weeks, but the law certainly hints to the fact that you should be spending all of the proceeds, forgivable or not, between February 15th and June 30th. So those are a couple of things we still have out there. How Walz Group can help. I'm not going to go through each and every one of these things. Know that, because there's a couple good questions that people have submitted that I want to leave a couple minutes for, but know that we're here to help you with strategy. We're here to help you with calculations. We're here to help you pull things together. We know that this is a difficult time for you and that there's a lot of requirements and that you might not have the time to put into navigating this entire thing. So we want to be able to help you in that manner. There's been a couple questions that come up, and Matt, if you want to scroll to the end, there's Ben and my contact information, and like we say, we'll get this out to you. But I want to we'll get the slides out to you so you'll have that contact information. But feel free to contact us at any point for anything you need. We're glad to try to answer your questions. But a couple good questions that came through here that I want to just take a minute or two to respond to, relating to the owners not as FTEs. So there the question was, what if we, in our original calculations, we counted the owners as FTEs? Or what if on the actual loan application we counted our owners as FTEs? Well, there's no reference on the forgiveness application about the FTEs that you put on the loan application. So I don't know that that's going to be a problem. So the good thing here about this is, if there's a silver lining, it's that if you're using a fractional method of forgiveness based on FTEs, you are, it's going to come out of the numerator and the denominator. So let's take the situation where you have 8 non-owner employees and 2 owner employees. So theoretically, you would have 10 FTEs. Let's say you had to let go of 2 of those non-owner employees, and now you're down to 8. So if you were counting the owners as FTEs, you'd have 8 out of 10, which is 80%. You can't count the owners. So instead of 8 out of 10, you have 6 out of 8. So that makes it 75%. So it goes from what we thought was going to be 80% down to 75%, a 5% decrease, which is not insubstantial in many cases, but it's not like you're going from 80% down to 6 out of 10, which is 60%. So important to note that the owners come out of the numerator and the denominator. So not ideal, but not as bad as it potentially could be. One other question here that I wanted to go over. In talking about the FTE safe harbor, does that mean that any time between January 1st and the end of the covered period, or just comparing those 2 specific dates? I think that's a really, really good question. I think that's something where it'd be great to have some additional guidance on it. I don't know if we'll get that. I've definitely heard some people who got these loans treating it as it's 2 separate dates. Like, you had 20 people on January 1st, you had 20 people at the end of your covered period, you're good. Now, what if you had 20 people on January 1st, went all the way down to 10 people by March 31st or something like that, and then, or April 30th, and then came back up? Do you have to look at it just as those 2 dates? that would certainly be the more advantageous way to look at it. That's the way that we generally have been looking at it, but it is possible that they're not talking about those 2 dates, that they're talking about that entire time period. And then one last question here that we got. What if you have both weekly and biweekly payroll, and how does that impact the alternative payroll covered period? Again, that's a really good question. From the payroll standpoint, pure cash compensation, I don't think it would be too difficult to have, 2 separate alternative covered payroll periods, because your biweekly period is going to equal your second weekly pay period. And as long as you're counting 8 weeks of both, you're probably okay. The question there would be in terms of your payroll costs that aren't related to compensation, such as retirement and health insurance. You just want to make sure that you're not using 9 weeks. I don't think that the law wants you to try to get 9 weeks in there. They've been pretty consistent about that 8 weeks. And even though there's an alternative covered payroll period, that's still supposed to last 8 weeks, which is why they're not allowing monthly or semi-monthly pay periods that aren't related to like a specific week. So my thought there would be, as long as you're using 8 weeks, you probably have justification for how that last weekly payroll comes in. But that would be my thought there. So those of you who submitted questions that we didn't get a chance to answer, we'll certainly do that via email. I want to thank everyone for their time and attention today. Again, please don't hesitate to reach out. We know that, as things are becoming, this unique situation is becoming more quote unquote normal. You're learning to navigate the situation, but we do realize it's still uncharted territory, and we're trying to help you through that. So again, please don't hesitate to reach out with any questions that you have. Again, thank you on behalf of the firm and on behalf of Ben for listening to us, and we look forward to talking with you later. Thank you very much.